The yield curve has now steepened by 1 full%, coming out of an inversion in just the past year. The last time we saw a move like this was in 2020, heading into the pandemic. Before that, it happened in 2007, right before the financial crisis. And before that, in 2001, heading into the dot-com bust. In fact, every single time the yield curve has steepened by this magnitude, it was either right before or during a recession. That includes October of 1929, when the curve steepened by 1% at the very beginning of the Great Depression. If we were to follow a similar path today, we could be at the precipice of another period of economic pain, one that would carry major implications for risk assets like Bitcoin. And believe it or not, the behavior of the yield curve today is already giving us a roadmap for how Bitcoin is likely to perform all the way into 2027, as we'll show you in this video. By the way, make sure to take advantage of the discount that we're doing for Cyber Monday. There's limited time remaining to secure our membership at this ridiculously cheap price. You'll get access to our entire trading strategy with all of our buy and sell alerts for each trade, where we take you from initiating a position to booking profits and closing the trade. Since the beginning of this year, our strategy has delivered multiple double-digit wins while keeping our losing trades very tight. If you're interested, you can use the link down in the description below. To understand how the yield curve influences Bitcoin, we first need to look at how this metric works. The yield curve takes a longer-term bond yield, like the 10-year Treasury, with a shorter-term yield, like the 2-year, and it looks at the difference between them. This is what it looks like. Most of the time, the 10-year yield is higher than the 2-year yield, which keeps the curve above zero. But there are periods where the 10-year yield falls below the 2-year yield, and that's what we refer to as a yield curve inversion. This typically happens because the Federal Reserve has been raising interest rates. They have direct control over shorter-term yields, so when they raise rates high enough, the curve inverts. This is what the Fed calls restrictive policy, and it slows lending activity across the banking system, eventually leading to a recession every single time. That's where the steepening phase comes in. This is when the curve begins to move back above zero as the Fed starts cutting rates, often because the economy is weakening. When we look at where the yield curve was at the start of the last 4 recessions, the levels were slightly different each time. For example, in 2020, the recession began when the curve was at just 0.2%. In 2001 and 1990, it was closer to 0.8%. And in 2007, the downturn only began once the yield curve reached 1%. So this range you see here is what we consider the hot zone, the area where recessions have typically begun. Today, the yield curve is still sitting inside that zone, which means we can't completely dismiss the yield curve as a recession indicator. If you had done that in October of 2007, when the yield curve was at the exact same level as it is today, the months that followed would have brought significant financial stress. You see, recessions are notorious for triggering major drawdowns in risk assets. If we look at the US stock market, it has declined during every single recession since the 1970s. And even a risk-on commodity like silver has seen the same pattern. Bitcoin, on the other hand, only emerged in 2009 after the financial crisis. So it has never really experienced a proper economic recession, other than the brief downturn in 2020, when the pandemic triggered a 50% crash in its price. But if we add the US stock market on top, we see that the two assets generally move together. So it's reasonable to assume that Bitcoin is unlikely to act as a recession hedge based on this relationship. After all, Bitcoin tends to perform even worse during large stock market drawdowns. This chart shows the performance of different assets during weeks when the US stock market fell by roughly 4%, essentially the worst 20% of its weekly performance. During those periods, Bitcoin saw an average weekly decline of about 5%. Gold and treasuries, on the other hand, held up far better and acted as effective hedges. So if the yield curve is right and the economy is moving closer to a recession, then Bitcoin, similar to the US stock market and silver, is also likely to experience a significant correction. Now, in order to assess the actual risk of a recession today, we need to look at the US job market, or more specifically, the unemployment rate. That's because the National Bureau of Economic Research, the organization responsible for declaring official US recessions, has a very specific definition of what they classify as a recession. And according to their definition, the very first determining factor is unemployment. If this chart looks familiar, that's because it is. It's almost a mirror image of the yield curve itself, and that's been the case going back all the way to the 1980s. Most of the time, the unemployment rate and the yield curve move in the same direction, but recently, the unemployment rate has remained historically low, despite the fact that the yield curve is steepening. This is unusual behavior because heading into past recessions, a steepening coincided coincided with the unemployment rising, thus confirming the recessionary signal from the yield curve. So if we are moving towards an official recession today, then a pickup in the unemployment rate should be right around the corner. And some might argue that we're about to see that rise, given the increasing number of layoff-related headlines circulating in mainstream media. But if we replace the yield curve with initial jobless claims, so the number of people filing for unemployment each week, we see a very different picture. Heading into recessions, jobless claims tend to rise first, and then the unemployment rate follows after. And that makes perfect sense because people lose their jobs first before they show up as officially unemployed. Now, if we zoom in, we can see that jobless claims are still sitting at very low levels and have actually moved lower recently. In other words, this is not yet signaling an imminent rise in the unemployment rate. Of course, this could shift quickly if claims begin rising sharply above the 260,000 level, which is a key threshold level we're watching. But until that happens, we don't see strong evidence that the unemployment rate is about to move significantly higher from here. So despite the yield curve sitting in the hot zone today, the probability of an economic downturn still appears low today. But that only tells us that Bitcoin is unlikely to face a recession-driven collapse in the near term. To understand the roadmap that the yield curve is giving us for Bitcoin all the way into 2027, we need to shift the yield curve forward by roughly 2 years. Here we can see that periods when this line is falling tends to be supportive for Bitcoin, and when it's rising, it has often coincided with major drawdowns in Bitcoin's price, with the exception of July 2017. Now, looking at the most recent shift, this rise here was already warning of a potential sharp pullback between August and November of 2025. And indeed, Bitcoin has shown weakness since August of 2025. But looking ahead, the yield curve is now pointing towards a constructive 8-month window from December 2025 through July 2026. This could be a period where Bitcoin finally finds its footing and begins to show renewed strength, something we'll be monitoring closely through the technicals. However, after July 2026, the yield curve is once again signaling a tougher phase for Bitcoin until mid-2027. Of course, this relationship isn't perfect, so we need to treat the timeline with some flexibility. But it does suggest that we're now entering a favorable phase for Bitcoin over the next 8 months. A quick reminder that we're doing a special discount on our service for Cyber Monday. This is our biggest sale of the year, where you get access to our premium membership for a fraction of the price. Our mission has been to provide investors with actionable, data-driven research that cuts through the noise. If you've been thinking about joining, this is your chance to get every trade we take in real time and our complete trading strategy for navigating the markets step by step. Our approach has delivered some exceptional returns in the past year, like 30% on Bitcoin, 63% on Solana, and even 83% on Ethereum. And more importantly, we've kept most of our losses contained to around 5%. We don't do such discounts often, so make sure to capitalize on it using the link in the description below.